Hi. Let's learn about long-term assets. Long-term assets are assets, whether tangible or non-tangible, that will benefit the company for more than 1 year. Also known as non-current assets, long-term assets can include fixed assets such as a company's property, plant, and equipment, but can also include other assets such as long-term investments, patents, copyright, franchises, goodwill, trademarks, and trade names, as well as software. Long-term assets are reported on the balance sheet and are usually recorded at the price at which they were purchased, and so do not always reflect the current value of the asset. Long-term assets can be contrasted with current assets, which can be conveniently sold, consumed, used, or exhausted through standard business operations within 1 year. Long-term assets are those held on a company's balance sheet for many years and can include tangible and intangible assets. There is no standardized accounting formula that identifies an asset as being a long-term asset, but it is commonly assumed that such an asset must have a useful life of more than 1 year. Some examples of long-term assets include property, patents, copyrights, and trademarks. Changes observed in long-term assets on a company's balance sheet can be a sign of capital investment or liquidation. The two main types of assets appearing on the balance sheet are current and non-current assets. Current assets on the balance sheet contain all of the assets and holdings that are likely to be converted into cash within 1 year. Non-current assets are long-term assets that have a useful life of more than 1 year and usually last for several years. Long-term assets are considered to be less liquid, meaning they can't be easily liquidated into cash. Depreciation is an accounting convention that allows companies to expense a portion of long-term operating assets used in the current year. It is a non-cash expense that increases net income but also helps to match revenues with expenses in the period in which they are incurred. Capital assets, such as plant and equipment, are included in long-term assets, except for the portion designated to be depreciated, expensed, in the current year. Long-term assets can be depreciated based on a linear or accelerated schedule, and can provide a tax deduction for the company. Long-term assets can be expensive and require large amounts of capital that can drain a company's cash or increase its debt. A limitation with analyzing a company's long-term assets is that investors often will not see their benefits for a long time, perhaps years to come. Investors are left to trust the management team's ability to map out the future of the company and allocate capital effectively. As with analyzing any financial metric, investors should take a holistic view of a company with respect to its long-term assets. It's best to utilize multiple financial ratios and metrics when performing a financial analysis of a company. Here are 3 key takeaways. 1. Long-term assets are investments in a company that will benefit the company for many years. 2. Long-term assets can include fixed assets such as a company's property, plant, and equipment, but can also include intangible assets, which can't be physically touched such as long-term investments or a company's trademark. 3. Changes in long-term assets can be a sign of capital investment or liquidation. Hope this would help. Thanks for watching.